This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
In any event, Patrick, I want to get on to your chart book. Listeners, you'll find the download link in your Research Roundup email. It says Big Picture Trading Chart Book. What are we looking at today, starting with page 2, S&P Futures? Ta-da! There's that acceleration I talked about in last week's market wrap to the upside.
That's right. And so we've seen the S&P consolidate into the option expiration, the gamma pin that was going in. We were looking for volatility. My bias was that it was going to be the downside, but clearly the volatility came back and it was with a big breakout to the upside. And what's interesting about that breakout, we've put on ourselves just the calendared straddles that we've done in the past. And while it really does help that this market is starting to move quickly, it doesn't really matter which direction. And the fact that this market is moving this way, I kind of asked the question, well, what is the drivers behind it? And this is where I thought was really interesting on chart 3. And this was a Goldman Sachs chart that they put out that was actually showing a really amazing phenomenon that's been happening. And that is the fact that in the options market, we are seeing that now 75% of the total open interest volume now lies in the weekly options that have 2 weeks or less till expiration. And so what we've seen is this speculative fever really grasp investors that are playing this rocket momentum that's happening in the markets by playing these front month options. But there's an interesting byproduct of that is the fact that the dealers who are often on the sell side of these call options, in fact, have all of this gamma risk. And in fact, as the market rallies, it's actually forcing them to be the marginal buyers of the stocks to stay delta neutral. And so we've found this real kind of fuel or accelerant that is actually accelerating the markets. And what's amazing as well, if you look on the right-hand side, what you can observe is the fact that the volume of call option buying is skyrocketing while the growth in volumes in put option buying is actually substantially curtailing from the highs. And you would think that with the market up along their highs, it would actually increase the desire to hedge some of the risk. And instead, everyone is just piling more and more into these call options on the upside. And this continues to drive and be that momentum, like throwing gasoline on a fire.
Patrick, moving on to page 4, holy cow, look at the size of that spike in the premium for S&P puts. Obviously, it's easy to say that's because of the pandemic crisis emerging, but wow, look at the size of that. What's going on, and what is the significance of coming back down to that red trend line?
So, Eric, when looking at this chart, what is amazing is that obviously when the market was crashing, the cost of buying out-of-the-money puts as insurance skyrocketed, and that's what you're observing. But prior to the corona crash, generally what we saw was that the cost of put options was relatively cheap, and especially when everyone's short gamma, and generally it was a period where buying insurance was relatively cheap. Now, in the post-corona period, we've seen volatility start to normalize. We see the VIX heading back down toward the 20 handle at this stage. But generally, as we showed on the previous chart, there isn't a structural demand for puts. No one seems to be worried about the downside risks of the market. And generally, the cost of these out-of-the-money puts are actually now coming to levels that are historically reasonably priced. I mean, we're to like the 85th percentile in terms of where we've been trading. But more importantly, since the coronavirus February, the median premium was 1.9% over the past 6 months. And so with us now being very close to 1%, it hasn't been much cheaper than in the last 6 months to buy put protection with the stock market up at along its all-time highs. So it's interesting that we're up here. And if you wanted to keep staying along the stock market and pressing up, it doesn't cost as much. It's never been cheaper in the last 6 months to buy put protection on your portfolio.
So the strategy of a long protected by a protective put, what some people call a synthetic call strategy, is cheap again, which it hasn't been since the crisis began.
That's right. And so it's just a thought that, those people that want to continue to participate on the upside of the market, starting to put in some hedges, it might seem like a reasonable proposition after we're going almost 5-6 months of pretty much straight up on the market, right? And so another interesting thing I wanted to look at on is page 5 and 6. And I just really wanted to put in context the magnitude of the rally that we saw in the NASDAQ over the last 5 months. And so what I wanted to start with on page 5 is just looking at the fact that when you go back to the 1999-2000 blow-off of the NASDAQ, when it broke out, it rose in 100% or doubled in its value in 160 days. And what's interesting is we are now approaching the 160-day mark off of the coronavirus low in March. And so on page 6, what we can see is that we've now seen a 70% rise in those 160 days. And so it's interesting to put context in terms of just the magnitude of the rally. Now, admittedly, there's a reflexivity to the fact that the NASDAQ crashed in the prior month before this rally is being measured. So I'm measuring off of an incredibly oversold low, but it is just showing you also the magnitude of this rise. And I mean, it's a second only to one of the greatest bubbles we've seen. And it's really interesting to see how long the bulls can keep this momentum running before we see that mean reversion that inevitably happens on every one of these types of rises.
Well, it certainly is fascinating, Patrick, to see just how dramatically the recovery has been. And I think it makes perfect sense. The NASDAQ, primarily tech stocks, which are, less affected. There's a lot more people buying stuff on Amazon and watching their Netflix accounts because of the crisis. Straight up and new all-time highs. And it's just amazing. Not only is it interesting to me that 70% has happened in 160 days, but look at the difference between the March bottom. You got back up to the previous all-time high, and then you went more than that's, the distance from the March bottom to the all-time high. You went more than that much up again in order to get to the current high. So it's a really profound move. Speaking of profound moves, let's move on to page 7. Lumber futures. Oh, wait a minute. Is this Tesla or lumber? Yeah, it's lumber futures. That's it.
Everyone's talking about this parabolic rise or this big, huge rise in the NASDAQ and technology stocks, but there is one market that has actually been outperforming the NASDAQ, and that is lumber futures, which are limit up today, and they, off of their March lows, are up 250%. And so this has been just a stunning trade for anyone who's gone long lumber. And what's amazing to me about what's happened here is that intuitively, on one side, I would have thought that with a huge rise in unemployment, that generally that would have actually decreased the demand for new homes and real estate. But in fact, what we've seen is the opposite. We've had Josh Steiner and Kevin Muir talking about this idea that inevitably the millennials are going to enter the housing market and start to buy homes, and that there was going to be a boom driven by the millennials making that move. And what we're finding, at least the speculation is that with the coronavirus basically shutting down cities, it actually has acted like the trigger or the fuse to actually begin this transition, and the demand for homes has actually been skyrocketing. At the same time, we're seeing that many of these mills have just not been running at full capacity because of the coronavirus, and this has created like a perfect shortage in lumber. And it's going to be really interesting to see how this plays out. I mean, this thing is just going absolutely mental to the upside.
Patrick, I think the trend that underlies all of this has a long, long ways left to go. Now, I don't know if it manifests itself in even higher lumber prices or not. You'd have to do some analysis on exactly where the bottlenecks are in that market. But I don't see it quite the way you and Kevin do, where you're talking about accelerating a trend that might have already been in play with, let's say, a millennial generational, move out to the suburbs, and that creates some more demand for housing. I think that the coronavirus crisis potentially is going to change the world forever. And the reason is it's the catalyst that really brought about a change that was already enabled by technology. We've had the ability. Let's say, take New York City, the most expensive real estate, or maybe second most expensive real estate next to Hong Kong in the world. Why would you pay, $2,000 a square foot or whatever it is to buy an apartment in New York City, where a little studio apartment costs upwards of $1 million? Well, the reason is if you want to work in the finance industry, which is probably the best paying jobs anywhere, it's where you physically had to be. And second of all, in terms of, restaurants and being able to enjoy your wealth, New York City is the place, best restaurants on earth, it's it. You can go to just a few places around the world, like Aspen, Colorado, where they have bordering on New York City quality of restaurants and quality of amenities for life. But there aren't many places like that. Usually the trade-off is you move out of the city and you end up with crappy restaurants and not the kind of selection that city dwellers get used to. I think that what we're seeing is the beginning of a trend whose real enabler is technology. It's the fact that we can work from anywhere over the internet that is going to make it possible for people to move out of big financial centers like New York and London and so forth and live in the countryside. And if I was a real estate guy, you got to invest in what you know and understand, and real estate is not my thing. But if I was a real estate guy, I wouldn't be looking at building the next hotel or the next little, bunch of tract houses. I would be saying, look at a map, find me closest to New York City that I can get, where I can buy a lake and 10,000 acres minimum, and I can develop a new high-end Aspen, Colorado-like place that is out in the sticks where everybody gets a 2-acre lot and it's on the lake and they've got their little dock with their boat and the whole living in the country bit, but it's got restaurants that are like New York City and it's got solid public transit and we're going to build that whole village. I would be looking at that kind of project because I think the move out of New York and move out of London and move out of Los Angeles trend is going to be huge, and it's going to depress property values in inner city environments, which used to be the most valuable real estate. And I think it's going to put demand, especially on high-end housing, in resort areas. And you're already seeing it with places like Whistler, Canada, and Aspen, the best ski resorts that are also summer vacation destinations are going to turn into full year-round destinations. And you're already seeing that. And I think the building in those areas is going to go through the roof. But let's move on to page 8, Patrick, and talk about iron ore. Why did you pick this chart to add to the book this week?
So, Eric, I want to actually talk a little bit about inflation. And one of the biggest inputs in inflation are commodity prices. And the biggest one, of course, is crude oil. But we already talk about that on every single show. What I really wanted to do was touch on some of the other ones that we rarely touch on. And so we talked there about lumber, but now I want to talk iron ore. And iron ore continues to gravitate toward 5-year highs. And it will be really interesting to see whether big breakouts in these types of basic materials really start to emerge and really reconfirm this idea that some sort of material rise in commodities is underway, which will inevitably translate to some transitory inflation that will start to reflect on the charts. And so what's interesting is that when we go to page 9, I have the 10-year break-evens. And what we can see is not only are we seeing the high of the year printing right now, but we're actually approaching the 2019 highs, up around 180. And so it'll be really interesting to see whether or not these inflation expectations continue to edge higher. And when we go to page 10, we can really see what I have is the 210 steepener. And not only were we negative and inverted on the curve back in 2019, but we now are finding ourselves putting in what was clearly a bottom along there, and we're making higher highs and rolling up. The particular interesting thing about this yield curve steepener and the idea is that it really would have to be a bear steepening. The Fed is not going to take their foot off of the front of the curve, pinning it down toward zero. And so really what this is going to be all about is whether or not inflation expectations expectations rise, and it starts to be baked into that 10-year yield. And it'll be really interesting to see whether we're in the midst of a new breakout in the steepener.
Patrick, you make excellent points. I think it is important for us to point out, in the case of iron ore at least, iron ore comes from Australia and Brazil, two countries very, very badly hit, particularly Brazil, by the COVID-19 crisis. So one of the things that remains to be seen is, first of all, how long does the crisis last? Because nobody really knows. When we do get some degree of recovery from the COVID-19 situation, do those iron ore prices come back down because they were driven so much higher by mining difficulties of production because of the crisis, or were they set to have this move anyway because of inflation, and the COVID crisis just provided the catalyst to turn their direction around? That's going to be really interesting to see, but I think the inflation break-evens suggest maybe it's more likely to be the latter. Meanwhile, Patrick, the latter slide in the deck, slide number 11, tells our listeners how they can get a free trial to your service, Big Picture Trading. Folks, you can get Patrick's commentary just about every day, 4 days a week, on bigpicturetrading.com. Be sure to check it out and get your free trial.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.